We are back in the black hole of real estate. These days we are running into so many scenarios that we think are unique and different, when in fact I think they actually are quite normal, but it's leading to something, and the market may just be taking just a little bit of direction. This is your host, Ron Wysakarski, for the black hole of real estate, and I think it's time that we just call it what we see right now. The market isn't unlike most markets. You see, most markets that we have seen over the last 20 or so years, maybe 30 or 40 or even further back, were ones where the interest rates were 6, 7, 8% back, in the 80s. Interest rates, we've heard about the, 20% interest rates. And even, the late 80s, when it got below 10%, and I'm here to tell you, the first mortgage I got was 9.875. I thought I got away with something. It was under 10. And when I got a 9%, I literally said to the loan officer, lock it in at 9. We'll never see rates this low again. And of course I was wrong. I've been wrong. They've never been that high again. But at the time, when you're coming from 20 down to 10 and then down to the 9, it felt, it was euphoric. And what we're finding right now is that people are taking their time to buy homes because it's, the proverbial biggest purchase they're going to make in their life. It's huge. So they should take their time to do it, and they should be methodical in the approach and make sure that they can afford the home, and that they can also have money for things like food and groceries and maybe a family night out or whatever goes along with that. And most people take 6 months or a year to design and plan for a move. Now, we got deluded into thinking that hyper-fast market during COVID, when we just bought things all willy-nilly, where there was no inspections and no appraisals, and we just, hey, you want $300 for a house? Hey, I'll just give you $400 for it. And you can stay there as long as you want, and I'll just move in eventually, but yeah, we'll just pay it extra. You see, that's what we got deluded into thinking was the real market, when what we're going through right now is the actual market. And if you think back to the 2008 financial crisis, which we are not in right now, and we're not going to be in, but a few years later, in 2011 and 2012, we were in an extremely similar market. Listings were taking above 180 days to sell. So if an agent had a 6-month listing contract, it was almost a guarantee that you would have to do an extension in order to get it sold. And not every property back then was a short sale. It felt like it, and I can tell you the first 100 deals that I did were pretty much all short sales. But within that were traditional sales that got lumped into the same phenomenon of everything taking 6, 9, 12 months to close. And if you had a traditional sale, your lever was price and time. It meant that you can price it with all the other short sales, or you could wait it out, price and time. And if you were the stubborn homeowner back then and said, well, my house is not a short sale, I'm not over a barrel, I'm going to price it $50,000 or $100,000, then the unfortunate people who are getting foreclosed on. And you know what the buyer said? They said, so what? All I want is this house, and it's got the same bedrooms, bathrooms, square footage. It might even be in the same neighborhood. And if you want more, I'll take the foreclosure one. And if I need to put a few bucks into it, I'll do that, because chances are the buyer was going to put money into any home that they bought, whether it's painting or changing out floorings or maybe some countertops or landscaping. Not every home was a complete disaster back then. So there was a lot of reason for buyers to wait for the short sales, to wait for the foreclosures, because the traditional sales, on balance, were either priced much, much higher, or they just took them off the market prematurely because they didn't want to take the price reductions. And we see that right now. If you fast forward to today, it's taking, in most markets, about 6 months to sell a home start to finish. Now, there's still the quick ones, and there's ones that take way longer, but that's every market. So let's call it neutral. And if we're working with medians, which is kind of the middle price, the middle sale, the middle number, we're very close, eerily similar to 2011 and 2012. And if you're an agent, you really had to be on top of your game. It was endless follow-up. And if you were an agent back then, or if you were buying or selling back then, the report probably sounded like, we had a couple of showings, no offers, the feedback was that the price was too high and it needed repairs, the end. And you would do that for weeks and weeks on end, to the point of frustration. From the agent side, if you hung in there long enough and had thoughtful conversations about the frustrated seller, then you stood a chance to get that extension and get it sold. And if you worked with a buyer that really wanted to buy something today, and they saw a foreclosure or they saw a short sale, I got cash, I can close right now. Oh yeah, but the bank's going to take 3, 4, 5, 6 months to close it. You're going to have to be patient too. It was a clear case of buyers and sellers not getting what they wanted, because not everybody was affected by the financial crisis. And if you were fortunate enough to have a traditional sale or cash in hand to buy a property, you couldn't always get what you want when you wanted. Pretty sure that was a song. And go Rolling Stones, right? So now we're in slightly different but same scenario. Buyers have cash, can't find what they want. Sellers are reluctant to go on the market because it's taking a while to sell property, and they're not seeing anything that they want to buy, and they're waiting for the other person to move first. And we've got this weird game of hokey pokey going on right now, where I put my house on the market if there was something out there I'd like to buy. And when enough people do that, it restricts some of the inventory that others would be looking forward to, and it causes others to delay going on the market because they feel like they're going to have pressure to find a different home if their home sells too quickly. See, that's an extension of COVID. And when you intermingle it with what happened 15 years ago, this is the soup that we're in. So it's not a new market. It's pieces of older markets intertwined a little bit differently than they were in the past. So what's the fast forward vision? My suspicion is more homes are going to come on the market in the fourth quarter. And if you want to include September into that, fine. The last quarter and a quarter, 4 months. What we are going to see is more homes coming on the market. It's highly predictable now that rates will come down at the September meeting for the Fed. Banks have already priced that in. So if they drop a quarter point, I don't know if you'll see a lot of movement from the Fed as it relates, to interest rates on home mortgages, because I believe when the Fed finally does a quarter, the markets are just teeming at the brink for this. They're waiting for the quarter point. I think by you hit September 16th and 17th, you might see a tiny drop, but I think it's already priced in. Now, could the Fed go to the extraordinary route and drop a half a point? Highly unlikely, but there's a lot of momentum behind it, and that could very well be the thing that keeps the housing market moving in a positive direction for sellers and for buyers. See, a half point would be compelling to everybody. That would get people off the fence as sellers. That would get people off the fence as buyers, and it would make things more affordable all the way around. In none of these scenarios do I see that it's going to affect prices negatively. Prices are up for the year. The first quarter, second quarter, year over year, they were up. It's likely to continue to be up. And if it's off just a little bit, it might just wash out some of the earlier gains of the year, but I don't see prices turning negative for the whole year. I don't see that, especially when you look at things nationwide, because not every market is as affected as certain areas. And it's not just the run above housing prices. There is a lot of information out there right now about people moving from red states to blue states, or blue states to red states, and you can do the research and decide which direction they're going. But there's some clear trends within that. There's some big industries that are building, different. The Amazon plants, for instance, are going up, and then the moving of the Space Force. That's moving from Colorado to Huntsville, Alabama. So things, a big ticket stuff like that. And with tariffs, there's a push in the auto industry. Defense weapons, we're making a lot of those, and we're apparently selling to NATO. The NATO gives them to the Ukraine. There's a lot of other things going on in industry where America is making different products, and maybe the tariff game is going to work. I don't know. That's for somebody smarter and different than me. What I know, there's this activity in the market, there's movement in the financial markets. What I don't see is people with $400,000, $500,000, $600,000 homes just selling them for $100,000 less or $50,000 less, some dramatic, 8, 10, 20% drop. I don't see that. because those people are not necessarily in a financial hardship. They may not like inflation, but most of the people in that, they have these interest rates in the 2s, 3s, and 4s that they can't replace. So the move becomes most likely about being in the right home at the right time at the right price and wanting something different. But economically speaking, is that one extra bedroom worth moving up 2 or 3 or 4% in your interest rate and paying more money than the home that you're in right now? Most people are just going to stay there until there's a counterbalance, and it's mostly through interest rate where I see it's going to come. I don't think it's coming from price, because the price pressure was different than during the financial crisis. Back then, people were losing their homes, they were being foreclosed on, and the upper portion of the market right now, I don't see that happening. Now, in the lower portion of the market, perhaps lower price points, if somebody bought FHA or VA and got a lot of closing costs mixed into their purchase, the seller helping to pay for that, if they had to sell within a year or two, they might be in a place where they might have to write a check at closing, or maybe that's a short sale, but it's not most of the market. There's a big equity spread between what people paid and what it's worth today, and that's why people are hanging on to the properties right now. Ergo, I don't think prices are coming down, at least for that segment of the market. Now, you can disagree with me, and that's where you go to drop the comments in here. You absolutely got to subscribe right now so we can keep having this conversation. But I think I know where it's going. It's lower interest rates, prices about the same, or a little higher. And what if we get 0.5% instead of 0.25%, September 16th and 17th? We'll be watching. This is your host, Ron Wojciechowski, for the Black Hole of Real Estate.